You open your banking app and see a notification. Pre-approved personal loan, $45,000 at 7.9% interest. No application needed. Just tap to accept. The money could be in your account by tomorrow morning. You scroll down. There's another offer. Credit limit increase on your card from $10,000 to $18,000. Approved automatically based on your payment history and income. You didn't ask for either of these, but somehow your bank knows exactly what you earn, exactly what you can afford to pay monthly, and exactly how much debt they can sell you without triggering default. Last month, you tried to open a business checking account for a side project you're building. The account required a $500 minimum balance, charged $15 monthly fees, and offered zero interest. When you asked about a small business line of credit, they wanted 2 years of tax returns, personal guarantees, and collateral. For your consulting business making $4,000 a month on the side, they wanted to see proof, history, assets. But for the personal loan you never asked for, the one that funds nothing productive, they're begging you to take it. This isn't random. This is engineered. Your salary doesn't make you successful in the bank's eyes. It makes you predictable, and predictable customers are the most profitable customers banks will ever have. My name is James, and I spend way too much time thinking about why banks treat your paycheck like a target on your back. If you've ever wondered why getting approved for a car loan is easier than getting approved for a business loan, if you've noticed that the more you earn, the more debt offers you receive, make sure to hit that subscribe button. Because today we're exposing how the entire consumer banking system is designed not to help you build wealth, but to extract maximum profit from your salary while keeping you dependent on that salary forever. We're talking about why the bank wants you employed, not entrepreneurial, and how breaking free from salary-based thinking is the only way to actually build financial independence. To understand why banks love your salary so much, we need to understand how consumer lending actually works. Banks don't make money by holding your deposits. They make money by lending your deposits to other people at higher interest rates than they pay you. It's called fractional reserve banking. For every $100 you deposit, they can lend out about $90. That $90 earns them interest. Your $100 earns you maybe 0.5% in a savings account while they lend it at 7, 12, or 18% depending on the product. But here's the critical part. Banks don't want to lend to people who will pay them back quickly and disappear. They want to lend to people who will pay them back slowly and predictably for years. A customer who borrows $30,000 and pays it off in 2 years generates less profit than a customer who borrows $30,000 and makes minimum payments for 10 years. The longer you owe, the more interest compounds, the more profit they extract. This is where your salary becomes gold to them. A salary is the most predictable income stream that exists. You have a contract with an employer. You get paid every 2 weeks or every month like clockwork. Unlike a business owner whose income fluctuates or a freelancer with variable months, your paycheck is guaranteed by an entity much larger than you, your employer. From the bank's perspective, your employer is their cosigner. They're not really lending to you, they're lending to your future paychecks. According to the Consumer Financial Protection Bureau, Americans carried over $1.1 trillion in auto loan debt in 2023. Almost all of it is underwritten based on salary, not assets. The bank doesn't care if you own a house or have investments. They care about your W-2, your pay stubs, your documented employment. That's the collateral, not the car. The car loses value the second you drive it off the lot. Your future paychecks, those appreciate with inflation and raises. Here's what makes this truly insidious. The bank's underwriting algorithms are designed to approve the maximum debt you can service without defaulting. Not the amount that's good for you, the amount that's profitable for them. If you make $80,000 per year, they calculate that you can afford about $2,200 per month in total debt payments before you start missing bills. So they approve you for a mortgage, a car loan, student loans, credit cards, all calibrated to keep you at that edge. You're always one emergency away from trouble, but you're never quite in trouble. That zone where you're stretched but not broken is their profit sweet spot. Let's walk through how this plays out in real life. Let's say you're 32 years old, making $95,000 per year as a software engineer. You've got $12,000 in savings. You want to start a SaaS business building project management software for freelancers. You've already validated the idea. You have 50 users willing to pay $30 per month. That's $1,500 in monthly revenue before you even launch. You need $20,000 to hire a developer part-time for 6 months to build version 1 while you keep your day job. You go to your bank for a business loan. They ask for your business tax returns. You don't have any because you haven't incorporated yet. They ask for collateral. You have $12,000 in savings, but that doesn't qualify. They ask for your business plan. You show them the revenue projections, the market research, the 50 confirmed users. They smile politely and say you need at least 1 year of operational history and $30,000 in collateral to qualify for even a $15,000 business line of credit. Application denied. 2 weeks later, that same bank sends you a pre-approved auto loan offer for $42,000 at 5.9% interest. No business plan required, no collateral, just your employment verification and your credit score. They'll finance a truck that depreciates 20% in year 1, loses another 15% in year 2, and will be worth maybe $18,000 when you finish paying off the $42,000 loan in 6 years. The business loan would have generated $18,000 in annual recurring revenue within 18 months if your user growth stayed conservative. But the bank says no to the income-generating asset and yes to the depreciating liability. Now let's escalate. You get promoted. Your salary jumps to $110,000. Within 30 days, you receive 3 things: a credit limit increase on your existing card from $15,000 to $22,000, a pre-approval for a home equity line of credit for $85,000, and an offer for a personal loan up to $50,000. You didn't apply for any of these, but your income went up, so your debt capacity went up. The bank's algorithm detected your raise and immediately recalibrated how much they can extract from you. Here's what didn't happen. The bank didn't call you to say, hey, your income increased. You should invest more in your 401k or open a brokerage account. They didn't suggest you allocate that extra $15,000 per year toward building equity and assets. They suggested you borrow more money because invested money leaves their system. Borrowed money keeps you locked into their system. But here's where it gets truly predatory. Let's say you take that home equity line of credit. You use $40,000 of it to renovate your kitchen, buy new furniture, and take a vacation. The interest rate is 8.5%. You're paying $340 per month just in interest. That's $4,080 per year going to the bank for consumption you already enjoyed. Over 10 years, if you only make interest payments and never touch the principal, you've paid the bank $40,800 in interest. They've extracted more than the original loan amount, and you still owe the $40,000. Meanwhile, if you had taken that same $40,000 and put it into an S&P 500 index fund at a historical 10% average return, it would grow to approximately $104,000 over 10 years. The difference between those two paths is $144,800. That's the cost of salary-based borrowing versus asset-based investing. The bank knows this math. They're counting on you not doing it. Let me show you the math of what salary-based debt costs you over a lifetime. According to a 2024 report from LendingTree, the average American with a salary between $75,000 and $100,000 carries approximately $157,000 in total debt. That includes mortgage, auto loans, student loans, and credit cards. Let's break down the interest. Average mortgage balance, $220,000 at 6.5% over 30 years equals $280,000 in interest paid. Average auto loan balance, $32,000 at 6.2% over 6 years equals $6,200 in interest. Average credit card balance, $8,500 at 19% APR, making minimum payments takes 15 years to pay off and costs $11,400 in interest. Total interest paid over lifetime on salary-based debt, approximately $297,600. Now let's add opportunity cost. If instead of paying that $297,600 in interest, you invested an equivalent amount monthly at 8% returns over the same time frame, you'd accumulate approximately $890,000. That's not counting the principal. That's just the difference between paying interest to banks versus earning returns in investments. The total wealth gap between the borrower and the investor is over $1.1 million. Same income, different choices about how to deploy that income. But here's the part that should make you furious. The bank will lend you $370,000 spread across mortgage, auto, and credit without batting an eye, all calibrated to your salary. But try to borrow $50,000 to start a business that could generate $100,000 in annual profit, and they want 3 years of history, audited financials, and your firstborn child as collateral. It's not about risk assessment, it's about customer retention. A business owner who succeeds stops needing consumer debt. An employee with lifestyle debt needs it forever. Here's how you fight back against the salary trap. Strategy 1. Stop thinking in terms of what you can afford monthly and start thinking in terms of what assets you should own. The bank trained you to ask, "Can I afford the payment?" That question keeps you trapped. The right question is, does this purchase generate cash flow or appreciate in value? If the answer is no, don't finance it. Strategy 2. Automate asset purchases before lifestyle expenses hit your account. Set up automatic transfers on payday. 20% of gross income goes to investments, retirement accounts, or business capital before you see it. Let your lifestyle adjust to what remains, not the other way around. The bank wants you to spend first and save what's left. Reverse that. Strategy 3. Every time the bank offers you debt, ask one question. Does this make the bank money or does this make me money? A personal loan for a vacation makes the bank money. A business loan that generates revenue makes you money. The offers you receive without asking are always the ones that profit them, not you. Strategy 4. Treat your salary as temporary and your assets as permanent. Your job could end tomorrow. Layoffs, acquisitions, industry disruption, health issues, any of it could cut off your paycheck. But assets you own, a business, real estate dividend-paying stocks, those generate income whether you're employed or not. Banks want you to build your entire life around your salary. Build it around your assets instead. Strategy 5. Use the bank's own tools against them. They approved you for $25,000 in credit because your salary supports it. Take that credit but deploy it strategically. Use 0% promotional balance transfer offers to fund income-generating projects. Use rewards credit cards for business expenses and pay them off monthly. Extract value from their system without paying their interest. The bank is a tool. Use it like one. Here's the thing about salary-based lending that banks will never tell you. It's not designed to help you build wealth. It's designed to extract wealth from your income while keeping you dependent on that income. Every product they offer, auto loans, personal loans, credit cards, home equity lines, they're all calibrated to one thing: your paycheck, not your potential, not your assets, your current, predictable W-2 reported income. The system works beautifully for them. You get a raise, they increase your credit limits. You get promoted, they offer you bigger loans. You stay employed, you stay valuable. You become financially independent, you stop needing them. The entire consumer banking infrastructure is built on the assumption that you will trade your time for money at a job for 40 years and spend most of what you earn servicing debt they sold you. But here's the truth they don't want you to realize. Your salary is not your ceiling. It's just the current market price for your time at one job with one buyer. You are capable of creating income streams that have nothing to do with your employment. You can own assets that appreciate while you sleep. You can build businesses that generate revenue without your active hours. The bank doesn't want you thinking this way because customers who think this way stop being customers. You are not an employee trying to afford your lifestyle. You are a wealth builder who's been systematically programmed to think small. The bank needs you to think small. They need you to believe your salary defines your worth. They need you to finance your present with your future, because as long as you're doing that, they own your future. Stop giving it to them. If this video just shifted how you see your relationship with your bank, smash that like button and subscribe to this channel. Next week, we're breaking down why your 401k is designed to keep you working until 65. I'm James, and I'll see you in the next one. Your salary is not your ceiling. It's just their starting point for extraction.